The Monday wipeout. Why paper silver is about to fail. There is a pattern in history. It appears over and over and over again. And every time people swear, this time is different. It never is. What you're witnessing right now in the silver market is not volatility. It is not speculation. It is not a bubble. It is stage 3 of a 4-stage collapse pattern that has destroyed every paper-based financial system that ever overreached the limits of physical reality. And once stage 3 begins, stage 4 is inevitable. This is the phase where confidence cracks, where insiders move quietly, where paper promises start failing stress tests. And when it breaks, it always breaks fast. The 4 stages, no one escapes. Let's slow this down, because once you see the structure, you can't unsee it. Every paper system tied to a physical asset follows the same life cycle. Not sometimes, always. Stage 1, the honest beginning. Every collapse begins with something legitimate. Paper certificates are created to represent physical silver stored in vaults. 1 ounce of paper equals 1 ounce of metal. Trust is high. Delivery works. The system functions. This is the phase that sells the idea. Efficiency, liquidity, modern finance. And for a while, it works. Stage 2, expansion and greed. Then comes leverage. Someone realizes, if most people never ask for delivery, why not issue more paper claims? 10 claims for 1 ounce, 20, 50? The system becomes a fractional reserve market, just like banking. As long as confidence remains intact, the math doesn't matter. This is when volume explodes, profits soar, banks dominate. And everyone becomes convinced they're holding the same thing. Paper silver and physical silver are treated as identical. They are not. Stage 3, crisis of confidence. Where we are now. Every collapse is triggered by a shock. War, inflation, a default, a geopolitical fracture. Something that makes people ask a dangerous question. Do I actually own what I think I own? That question is poison to a paper system. Because when confidence cracks, people stop trading paper. They demand delivery. And delivery reveals the truth. Premiums explode. Delays appear. Inventories vanish. This is the phase where insiders move first. Not loudly, not publicly, quietly. And that's exactly what's happening now. Why silver is the weakest link. Silver is not just an investment metal. It is a strategic industrial input. Solar panels, electronics, defense systems, medical tech. You can't substitute it, and you can't print it. Which makes silver uniquely dangerous for a paper-based system. Because when industry needs metal, cash settlement doesn't work. Factories don't run on dollars, they run on atoms. The math that breaks the system. Right now, on Comex, roughly 47 million ounces of registered silver, nearly 1 billion ounces of paper claims. That a 21-to-1 leverage ratio. The system assumes only 3% of holders will ever demand delivery, but stage 3 breaks that assumption. At 10% delivery demand, the vaults are drained. At 20%, the system fails instantly. This is not opinion, it's arithmetic. The first visible cracks. Here, as what stage 3 looks like in real time, physical premiums above 25%. American Silver Eagles selling $8 to $12 over spot. Major bullion dealers suspending sales. Supply chain disruptions. Inventory delays. Temporary shortages. That language is not accidental. It's the same language used before every paper collapse in history. History is not optional. This has already happened multiple times. In 1720, John Law's Mississippi bubble collapsed when paper claims exceeded silver backing. In 1933, the U.S. defaulted on gold convertibility and criminalized private ownership. In 1968, the London Gold Pool failed trying to suppress gold prices with paper. And in 1971, the world learned what temporary suspension really means, default by another name. Why this time is not different. Technology doesn't change physics, derivatives don't change scarcity, and trust doesn't survive broken promises. The only difference today is scale. The leverage is larger, the speed is faster, and the stakes are global. Silver is simply the first market where the stress can no longer be hidden. It is the canary. And when the canary stops singing, the miners don't debate, they run. Where this is heading stage. 3 always feels confusing. Prices whip, narratives conflict, people argue online. That's intentional. Confusion keeps people holding paper. But stage 4 is clean, paper burns, physical survives. And when stage 4 arrives, there are no warnings. Only settlements, only closures, only regret. And that's where we'll go next. Because the next phase is where the wealth transfer happens, where JP Morgan's role becomes clear, where the Monday wipeout scenario forms, where March delivery becomes the test. Now let's talk about who already knows this is coming. Because in every collapse, there are two types of participants: those who believe the story and those who read the balance sheet. And right now, one institution is telling you everything you need to know without saying a word. JP Morgan. The last man. Standing for years, JP Morgan was accused of suppressing silver, paper shorts, derivatives, price control. That story was incomplete. JP Morgan wasn't trying to destroy silver, they were accumulating it, quietly, relentlessly, for more than a decade. Today, JP Morgan is estimated to control nearly 900 million ounces of physical silver. That's roughly 44% of all investable silver on Earth. Read that again. While the public was trading ETFs, JP Morgan was taking delivery. And now comes the most important signal of all, the registered to eligible shift. In recent months, JP Morgan has been moving silver from registered to eligible status on Comex. That means still in the vault, but no longer available for delivery. This is not cosmetic. This is defensive. It tells you one thing: they do not intend to part with their metal. In a fractional reserve system, that is an extinction-level event. Why this guarantees stage 4. Remember the math. Comex has about 47 million ounces available for delivery. Paper claims represent nearly 1 billion ounces, and now the largest holder of physical silver has quietly pulled its metal off the delivery table. That means the delivery pool is even smaller than advertised. Stage 3 becomes stage 4 the moment one of two things happens. Either a surge in delivery requests overwhelms inventory, or confidence collapses, and paper holders rush the exits simultaneously. Both paths lead to the same place. The March contract, the stress test. This is why March matters. March is a major delivery month. It is when industrial users show up, not traders, not speculators, manufacturers, defense contractors, solar producers. These buyers do not want cash. They want metal. If delivery requests spike into double digits, Comex fails the stress test, and failure does not look like a press conference. It looks like cash settlement, rule changes, temporary delivery modifications, position limits, force majeure language. Every historical default used the same script. The three bad options, all bullish for physical. When stage 4 arrives, Comex has exactly 3 choices. Option 1, allow delivery impossible. The vaults would be emptied instantly. Option 2, forced cash settlement. Paper holders get paid at the artificial paper price. Physical metal reprices elsewhere. Trust is destroyed. Paper silver dies. Option 3, let the price explode. Raise silver to $150, $200, $300 to crush demand. But even this fails, because industrial demand is inelastic. Factories cannot stop. All 3 outcomes end the same way. Physical holders win, paper holders lose. The asymmetric bet. This is not speculation. This is risk math. Worst case downside, silver drops from $79 to $65. That's a 15-20% move. Best case upside, silver reprices to $240, $300. $800 as paper collapses. That's a 10x to 15x asymmetry. There are no other markets with this profile. Why volatility will get worse. As stage 4 approaches, price behavior becomes violent. Rips, dumps, headlines designed to confuse. This is intentional. Volatility shakes out weak hands. Volatility forces margin liquidation. Volatility transfers metal from emotional players to disciplined ones. Do not mistake chaos for weakness. Chaos is stress. Stress reveals truth. The final wealth transfer. Every paper collapse ends the same way. Those holding promises are paid in devalued currency. Those holding physical assets set the terms of the new system. This is not about profit. This is about positioning. Owning silver is not a trade. It is insurance against systemic failure. The binary choice. There is no middle ground. You either own a claim, a promise, a counterparty risk, or you own a bar, a coin, a tangible asset. When the system resets, only one survives. What to watch now? Ignore the noise. Ignore influencers. Ignore daily price action. Watch only 4 things. Comex, registered inventory below 40 million ounces, danger. Below 30, cakes imminent failure. Physical premiums. Above 30% means paper prices fiction exchange. Rule changes. Any mention of liquidity or temporary measures, dealer behavior when ON stock becomes delayed, it has begun final warning. When stage 4 hits, there is no buy the dip. There is no wait for confirmation. There is no re-entry. There is only availability, or the lack of it. Paper burns. Physical survives. And silver is about to prove it to the entire financial world. This is not fear. This is math. This is history. This is inevitability.